So the projections that you have on your personalised illustration show that by voting yes and accepting the offer that you are very likely to retire on a pension higher than if you opt out of the scheme and just accept the guaranteed rate. But what are those assumptions and how important are they in the decision you make? Well, perhaps the first assumption is that it assumes that you will retire and take your retirement benefits on that selected retirement date. It may be that actually you're planning to retire earlier than that. If that's the case, then it may be that you have a guaranteed pension rate that still applies if you retire early. In which case, if you are retiring within the next 10 years, that may be a strong reason why you would want to opt out and protect that guaranteed pension rate rather than take an investment risk. On the other hand, it may be that by retiring early you lose all entitlement to the guaranteed pension rate because, having looked at the Phoenix schemes on offer, some allow the guaranteed rates for early retirement and some don't. So if you're planning to retire early and you didn't have a guaranteed rate, then obviously that gives you a good reason why you might want to think about accepting the new offer and voting yes. The illustrations assume that you will take the pension commencement lump sum. By doing that, you're really only comparing the guaranteed pension rate on what's left of the fund after that lump sum's been paid out. If you can choose to not take that lump sum at retirement, then you're going to get guaranteed pension rate on the whole fund. It becomes more valuable therefore for you if you're planning to not take the lump sum, and you need to weigh up that process. You need to weigh up the illustration on that basis. The pensions assume that you are happy to take a level pension. It may be that you want it to increase at, let's say, 3%. Some of the Phoenix plans affected will allow you to take a guaranteed pension rate with a 3% escalation. Some of them won't. So again, if you like the idea of inflation protection but you don't have a guaranteed rate that applies for increases, then that would be a good reason to think about accepting the alternative offer. The projections assume that you will take a single life annuity. However, if you're married, you may prefer the idea that in the event of your death, with a pension and payment, there will be some pension that will continue to your spouse. As there are no guaranteed rates that apply for the spouse's pension, if you were to set up the pension with a spouse's pension, then the value of the guaranteed rate becomes diminished somewhat. So that might slightly edge you towards voting yes and accepting the enhanced fund value. The illustrations assume that you're fit and healthy. At retirement, if you're not fit and healthy, you may be able to get an enhanced annuity rate on the open market due to your health. If you're a smoker, smoking sufficient numbers of cigarettes, then again you might get an enhanced rate. So that would edge you towards accepting the higher current fund value. Perhaps most importantly of all is that if you're not in good health, you need to be checking the death benefits on your pension plan. Many of these affected plans are set up with a return of the contributions either with or without interest in the event of your death before retirement, and not a return of the fund. That could mean that your family will be left with a much smaller pension fund than you thought they would do. If that's the case and that worries you, then by voting yes to the scheme of arrangement and transferring it to a pension where in the event of your death the whole fund would be returned, could be a very good reason to act on this occasion. And what if you have other pension plans and you were thinking about not having a guaranteed annuity but looking at other forms of income in retirement, whether that's a drawdown or a with profits annuity or a third way pension? Accepting the scheme of arrangement and having a higher fund value that you can amalgamate with other pensions will give you a lot more flexibility in terms of your retirement choices. With profits has become much maligned over the past few years for a number of reasons. Accepting the enhanced value and then considering an alternative contract could be a get out of jail free card for many of you. If you stay in the scheme and you've voted yes, you should anticipate that the bonus rate that you receive going forward will be low. There's a greater emphasis nowadays with insurance companies to pay very low bonus rates on an ongoing basis and to have a far greater reliance on paying a final bonus if one's available at retirement. This reduces the guarantees to you and improves the position for the insurance company. Indeed, the independent actuary in assessing the deal that's been put forward to you has indicated that you should expect low bonus rates going forward. There's a number of things that get deducted from your returns in a with profits fund that you would be surprised about. These include, for example, when the salespeople have made mistakes in selling the contracts and there are fines to be paid, there's nothing to stop the insurance companies raiding the with profits funds in order to pay those fines. So that can diminish the return to you, obviously. Under the new scheme of arrangement, there will be much more prospect of regular bonuses and final bonuses than there have been in the past. 10% of the bonuses that they pay out will be paid out to shareholders. So again, that will generate a drag on the returns to you as a policyholder. Looking at the last set of accounts for the scheme, the net operating costs and the investment expenses and charges represented 0.9% of the fund. A with profits fund is a one-size-fits-all investment. You have to be happy with the investment mix they give you, which is 45% in the stock market, 25% in commercial property, 30% in fixed interest investments. Now that may be appropriate for a moderate investor, but if you're a speculative investor then that's probably not appropriate. You'd also be hard pushed to find an actively managed fund for a moderate or an adventurous investor nowadays that has 25% of the fund invested in commercial property. It's a questionable asset mix in my opinion at this point. But not only is it questionable, it's also fairly rigidly stated within the Principles and Practice of Financial Management document that that's the way it will be managed going forward. The with profits fund also reduces the risk as you start to approach retirement. So in that respect it takes into account your selected retirement age, but obviously that's a problem if you plan to retire at an age differently to what you've selected at outset. It's also an issue if, having accepted the offer, you were thinking, well, we're looking to amalgamate all these into a drawdown or an alternative pension arrangement rather than a guaranteed annuity, in which case you may not want risk to be reducing as you approach your retirement age, because you may still want to keep risk on the table once you're in retirement as well. And nowadays there's much debate about whether lifestyling is this nature of reducing risk as you approach retirement, whether that's the best approach, or whether the alternative, which is very popular in the American market, of investing with guarantees, the third way pensions, offers a potential better returns for you rather than the alternative. So there's a lot to consider. We think that in making your decision, you shouldn't just be considering the guaranteed pension that you've got versus voting yes and the alternative scheme of arrangement. We also think you should be looking at an alternative in terms of is there a better option if you were to take the scheme enhancement. For this reason, we believe you should be speaking to an independent financial advisor, ideally one that understands about with profits, one that can understand about pensions and maybe has a pension specialist status with the Financial Services Authority. This is particularly relevant if you have a Alliance transfer plan. And of course, ideally, it should be an IFA that understands about this scheme. Our third video will explain why we believe Fraser Heath is ideally suited to help you in this advice process.